learning how to think with an investor mindset that also doesn't conflict with your entrepreneurial values and drive to just constantly grab things by the reins and wrestle them to the ground. And so there are ways to do that, right?
Right.
That's the picture of an entrepreneur, and I think of...
It's a good one.
Yeah.
What's up, everybody? Welcome to another episode of Own the Exit. This is our entrepreneurial podcast. We get a lot of business owners on here, get a lot of entrepreneurs, get a lot of investors, and it's just really exciting having people on the show just to network, just to learn from each other. Today we're doing an episode just with me and Caleb, and we wanted to kind of talk through a couple things about diversification, about investing. I'm your co-host, Aaron. You've known me from the past.
Absolutely. I'm Caleb, your co-host for first time listening. We're thrilled to have you as part of the Own the Exit community. So
absolutely.
We're really passionate about helping business owners be able to build businesses that they can limit their active involvement from, if that means a full exit selling, or if that means, just building out systems and infrastructure in your business that doesn't require so much of your active involvement. That's the goal here, right? We're all looking for time freedom, financial freedom, the ability to, live a lifestyle by design, not by demand. And so that's a lot of our focus here. And so,
and the more we talk to people, the more we've seen the ways that people own their exit and how different that can be for people. There's some people that love working in their business and don't want to ever exit, but they can still have that mindset of getting that freedom, getting that time freedom. And so today we wanted to talk a little bit about being an entrepreneur, but having an investor mindset and how to combine those. What's the difference between being an entrepreneur and an investor? And how do those work together? And we hear a lot about diversification of trying to, take your, funds and put it in different things. And we've got a lot of thoughts on this we can dive into. But Caleb, what's one mistake that you have seen people make, or you feel people make when it comes to diversification?
Yeah, I think the biggest mistake that I see with entrepreneurs in terms of diversifying an investment is not actually investing outside of the thing that they're building. Right? Like never getting to a point where they're taking and peeling off cash flow and income and revenue from their business and actually investing it into something else that's unrelated to their company. Now, I know you and I've talked about this a lot. We talk about it a lot. Yep. When you're on the come up and you're building a business and you're in that initial build phase and growth phase, you need to believe and go all in on your business and invest as much as possible, pour as much as possible into building that business. So we're not thinking at that stage when we're in the initial build, we're not thinking there, but once you have some actual revenue coming in that business, once you're starting to see that momentum, there comes a point where you need to start peeling off some of that cash flow from your business and diversifying it over into other, investment vehicles. And specifically, I think for entrepreneurs, because entrepreneurs understand business operations and building individual businesses, I think personally, they shouldn't just be dumping it over in some mutual fund or shouldn't just be dumping it over in some 401k or IRA account or something like that and letting somebody else manage it. Like that's counter to the entrepreneurial mindset, right? Where it's, hey, I actually want to invest in something that's being built, that's being actively managed, that's being actually, and so to me, I think entrepreneurs, when they understand and start educating on private equity type investments, then they're like, oh, this makes so much more sense to me. Yeah. And I'll say one more thing. I saw their interview when Alex Hormozy went on Dave Ramsey's show or vice versa,
Yeah, he went to Dave Ramsey.
He went to Dave Ramsey's studio, but it was Alex's podcast. He's interviewing Dave. And one of the things he talks about that he gives Dave kudos for is Dave had a guest and they were talking about if your mind, your knowledge was reflected onto your investment portfolio, how well would it line up? And Alex said, when I had my big exit from Gym Launch, I was, he had a, $100 million payday, right? he's like, all these people are telling him, oh, you need to invest it here. Oh, you need to invest it there. You need to invest it in this mutual fund and this, type of real estate and this. And he was just like crippled of what to do in terms of investing that money. And he finally, like, listening to that podcast where Dave Ramsey said, made that statement, like, take your knowledge, put it onto, your investment portfolio and see how well they line up. He's like, I just need to invest in things that I actually really understand and that match how I would do it. Right. And
so you're saying only invest in what you understand?
I'm not saying only invest in what you understand, but I'm saying for entrepreneurs specifically, just going out and investing in, public securities, public markets, just because it's easy and efficient may not actually be the thing that you're able to really analyze and look at and come to like an understanding of private equity is something that you're far more familiar with because you've built a business with private equity, right? With your own money. You've poured your own money into a business. You know what it takes to build a business. So you know what to look at in investing in a business in private equity. And
that's why he's probably, he's doing kind of venture capital and with all these kind of early stage businesses or ones who, if you hit $1 million in revenue, he's like, hey, we can talk because you've just started.
Yeah, exactly.
But then he can, since he's done it from the beginning, he can
take it from $1 million to 10 to 50, all that stuff. And so,
I would say too, like, it's like, we've heard the quote before that one of the keys to innovation is a lack of resources.
Yeah.
So if you do peel off 10% of your money and you start putting it into these other, diversified, whether some kind of investments, alternative investments, other businesses, it's not your main thing, but you'll figure out how to still do your main thing with 90% of your money.
Yeah. 100%.
But then what starts happening over months and years is that 10% starts building up and it's passive, or maybe it requires a little bit of involvement or just looking at it, but you can still, it's not going to necessarily take away. I think that, as entrepreneurs, we can probably get that same end result with 80% even, right? By putting 20% away, and then if everything crashes and burns, at least you're like, well, hey, I forgot I got this $500,000 over here, Well,
it's like we had the episode, right, with Travis Goff, however long was a few weeks, month ago or something like that, where, Travis built over 7 years an insanely successful company, 100 employees. This was they had a 9-figure exit lined up. They were at the due diligence stage of that, and like everything was going to go through. And he had the foresight to, earlier on start peeling off some money from that business and investing it into real estate on the side with a partner and into some funds and into some syndications and stuff like that, and start, and creating and generating this whole other thing that didn't require a whole bunch of his time.
Yeah.
But because of his knowledge of how to build a business, real estate's basically one of the most simple business models that there is, right? Like there's one sort, you've got revenue, you've got expenses. And if you can increase the revenue and decrease the expenses, you can increase the value of the asset. Like it's really that simple.
Yeah.
Right. And so
simple but hard.
Simple. It's simple to understand. It's not necessarily
hard to execute.
Yeah. It can be hard to execute from an operations standpoint, but that's just why you get really solid operations partners. But truthfully, like when his 9-figure exit fell through, if he hadn't had that, he'd have been screwed, man. Like he would have been in a really rough place. You're starting right back at zero. And so that's why I think, there's wisdom in when you get to a certain point in your business, starting to peel off some of that cash flow and get it going somewhere else that doesn't require a bunch of your active involvement. I call it unrelated, right? Because it's not only is it passive and uninvolved, it's also rather I call it uninvolved, right? It not only is it passive, but it's also unrelated to your primary business, right? My personal goal, and I'm not putting this on anyone else, but my personal kind of breakdown, you mentioned 90-10. For me, like I think 60-40 from business to personal, and then from personal down as well. So like I want to reinvest 60% back into my business, 40% into something else. Right. And then when it comes to like what I actually take for my family, then it happens again. I want to live off of 60% of that and store up and invest another 40% for my kids' future. Right. And so, you know, for my family's future, for my wife and I's security, but also, you know, a wise man leaves an inheritance to his children's children. And so for me, you know, my kids may not want to inherit the business. They may want to do something else. I want them to still, you know, start further along.
Yeah, no, mentioning family is good too, because I know the idea of, and I was talking to a mentor 10 years ago, and he was like, you just need to peel off like 20%, because for your family, like even for my wife, she likes that. She likes that there's some additional funds or money that's like hard to access or whatever, or something that's not, you know, because we, you know, we're business owners. But it's good to have that, even for like having that peace of mind. When you're an entrepreneur, you might not care. You're just like, whatever, I'll just lose it all, you know? But, you know, as you go along, you start to kind of get wiser and also knowing like, you know, for my wife, she's not wired that way. She likes the security of knowing that the savings are there. Like she's more thinking along those lines too. So that can be good just for the relationship. But I've gone back and forth on this with getting too diversified, almost being like I call it the shiny object syndrome. Where I want to put 50,000 into like 50 things that are all exciting. You know, things that I'm doing, things that other people are doing, you know, and but then it's like, you know, I've had to rein in my focus. And put all of my money into my current business that I'm building, because it's just at a stage where it requires like all of my attention and resources. But that's just a season, right? Where, you know, like you said, when you're starting something new, you know, and I do have some money in other places. Like I actually just sold 2 houses, and we've got them in our 1031 exchange. So we're going to put that. We're looking at this oil and gas thing. That's a 1031 friendly investment, and I'm not going to be able to access it, the money, right? Like it'll have cash flow that comes off, but it's not I don't do that. And so that's kind of cool because it's a separate, you know, and there's just an example. So it kind of forces me to peel off either that, or I can take the money and pay like 40 grand in tax. And so that was just a practical example of, you know, being able to shave that off. So, but yeah, I mean, I think it's just wise to do that and to be thinking that way.
Absolutely, man. I mean, I think even, you know, you mentioned with the current business, you know, you're just reinvesting everything because in this huge growth stage, right? Like the business is really booming and needing a lot of resources, but also is producing and creating a lot. With that, like still the mindset piece of it is valuable, because when you're reinvesting into your own business, you have to think like an investor in doing that, right? Like an investor is thinking, where do I place my money to have the least amount of risk in exchange for the greatest amount of potential return, right? Like that's what you're looking at, is risk to reward ratio, right? And so then even when reinvesting in your business and putting a lot of money back into your primary company, really thinking about, where do I place that capital? What's the priority where I'm investing? Or am I just dumping money in it to keep this thing going and not optimizing things, right? Not trying to. And so I'd love for you to just, you know, share maybe with our listeners like 2 or 3 tips for how you view reinvesting in your business through the lens of an investor mindset.
Yeah, no, I think that's, if you can separate yourself from your business, like let's just say let's say you're putting $1 million into a business over, you know, whatever time period. pretend that it's a different person that's putting that $1 million in. Because then you're looking at it as an investor would. Be your own VC.
Yeah.
Right. And separate it out where it's an owner contribution into the business that needs to get paid back.
Yeah.
And so when you look at it that way, so it doesn't just all merge into a muddy, where it's like, and that's kind of just how it is sometimes at the beginning. But I always fight for the clarity of like roles, time. Like time is an owner contribution.
Yeah.
Like if you're a business owner, like I'm not, like if you're not getting paid like a salary, then what are you doing, right? You're just working for free. You're putting all your money in and you don't even know, like, I don't even know how much I've quote lost so far, like maybe the business will be worth more one day, right? But so it's not really an investor mindset. But I think just tracking it and just being like cognizant of like, hey, if I have $50,000, I said $1 million, but I mean, usually it's smaller, right? It's chunks as you go along or whatever it might be. And of course the business is throwing off money too. But then when you put it back in to look at it like an owner contribution again.
I need a return on this.
Yeah, and even like, because I've got a lot of different entities and everything that I have ownership in that sometimes the money will transfer, but I track it all.
Yeah.
It's this entity owes this entity X amount of dollars, and I don't know if that entity will ever pay them the other entity back or not, but there's a paper trail for everything. So that are looking at it as an investment. And I think too, another thought is the difference between entrepreneurship. When you're an entrepreneur, if you lose $50,000, you can just go create it again.
Yeah.
Because it's your time, because you're the income generating asset. Yeah. Like you're the one that's going out and creating that new $50,000. Yeah. If you're an investor and you lose $50,000, it's gone. Right. And you can't get it back. Exactly. It's different. It's not. So a lot of times like entrepreneurs are really bad investors. Right. Because they're so used to creating where they're just like, they just roll with it and they throw everything in and they just give all their heart and soul and they keep making more money and they're losing money over here, but making it here. And this thing's growing and this one's not as good. And they just keep going until they're successful. You can't do that when you're an investor. Right. Because when the 50,000 is gone, it's gone. Right. And it's zero now. And so you don't have any investment capital anymore. Right. And so I think that's something that's important to be thinking.
There's nothing you can actively do to get that money back, right? And so, and that's I think transcribing that over into thinking about being an investor in your own business, right? You talk about owner contribution, right? Like you're putting 50,000 into your own business. You have to be able to delineate in an investor mindset, like, am I investing and this money's going into something that I believe if it was somebody else's money would pay a return to them.
You have to.
Right. You have to think in that way. You can't think, I'm just going to pour another 50,000 just to try to keep this thing afloat. Right. Because it's like, you're not thinking like an investor. You're thinking only as an entrepreneur and chances are you're just going to keep burning through capital, throwing money at problems rather than actually solving them. Yeah. Right. And that's kind of I think that's kind of the whole point around it is eventually you get to a point where your business is not requiring you to continually reinvest in order for it to grow. It becomes a little more self-sustaining.
No, absolutely.
Right. Then peeling some of that off.
Yourself back. Because you're the investor.
Exactly. But then that's where you start paying yourself and then pushing that over into, other things. And hopefully at that point, then you've got a better grid on how to take a look at a deal, another investment opportunity and get a good idea of, because you've already been practicing that investor mindset, right? Of, investing in your own company. So that's kind of the idea.
You said of growing that and then pushing it into, because I think you just have, when you're first starting out, you got to look at the limited resources that you have and where am I going to make the best, what's going to be the best return? And I would say you're investing in yourself. Yeah. If you only have $50,000, but you're brand new and you're 18 and you've never done anything, like investing into yourself to increase your own, you'll probably get a larger return doing that than investing it in some investment that's initially. But as you start growing, your own skill set, your own mindset, and then your own income streams. And you have a business, like you said, that you have a business that's self-generating, or self-sustaining. I mean, where, then you can start peeling off, but, no, I think it's good. I think it's even that idea of like, the wealthy barber, it's a book where the guy, he just puts away 10%, and ends up being a millionaire. That's in very simple terms. Anyone can do that, just working a normal job.
Yeah.
But it's the same concept in business though.
Yeah.
To shave off and kind of pay yourself first,
Yeah.
but push it somewhere where, I would even say somewhere where you can't get it.
Yeah.
And that's why I like syndications and this oil and gas thing that I'm looking at is like, it's honestly, I don't even know where it is. I'm just putting it in a fund, but I trust the guys.
Yeah.
And I won't be able to get it for a while.
Right.
But that's the
goal.
plan.
Right.
I want it to be there, and it'll throw off cash flow, which will be nice. And I think within 2 years or something, I'll get a lot of it back with cash flow.
Absolutely.
But just looking at it as an investor, right?
Man, absolutely. This is a great conversation. I think just to recap, we're saying, to those of our listeners, we're saying if you're a business owner, reinvest back into your business. Yes. Yeah. Like you're going to get a bigger return that way, even though a portion of that return is going to be tied to your activity and your work. But make sure that you are thinking about, at least starting to think about how you can shift to an investor mindset and start peeling off some of your cash and investing it into things that you aren't the one responsible for, right? Other businesses, apartment syndications, some of the oil and gas stuff that Aaron's like, there's a whole variety of opportunities in the private equity space that you can invest in where you can actually have a greater level of insight into the specific thing that you're investing in.
People's businesses,
other
where
people's
they're the
businesses,
operator.
those kind of things. And so, that's kind of I would say just the overall recap is diversification as an investor entrepreneur, as an entrepreneur investor, looks different than the guy who's, just working a W-2 9 to 5, pouring money into his 401k, right? Like that's not the appetite that most entrepreneurs have. And so learning how to think with an investor mindset that also doesn't conflict with your entrepreneurial values and drive to just constantly grab things by the reins and wrestle them to the ground. And so there are ways to do that, right? That's the picture of an entrepreneur, and I think of...
It's a good one.
Yeah.
You got to do a little illustration for that.
Exactly.
Like grabbing a bull and just
grabbing a bull by the
thing.
horns and just ripping it to the ground, right? Yeah, exactly. That's the entrepreneurial game, right? You're grabbing it by the horns. And so...
But these little investments too, I just wanted to say, over time, those could start to even overshadow. And then your business will just become one of those. Because then you can step out and now you're just an investor. Yeah. And one of the things you're investing in happens to be your own business.
Your own business, yeah.
Along with 10 other things.
That's the cool end game. And that'll be kind of like the final thing I'll say is re-quoting a statistic that we've probably said before, or a fact or a piece of data point that we've said before. And that's, last year, the CEO of Coca-Cola made $23 million. And Warren Buffett, as an investor in Coca-Cola, made over $200 million. The CEO's working every day, bro, working his tail off for that $23 million. And then Warren Buffett, just as an investor, is making 10 times more. Yeah. Right. And so understanding that the investor mindset is what is going to, in the long term, if you do it with consistency, get you to the point where you're
94, you'll be there.
Exactly. So when you're 94 and almost dead, that's what it feels like as an entrepreneur. Sometimes it's going to take that long, but the truth is as an entrepreneur,
been doing it for decades.
If you do it right, he's been doing it for decades, but he's also been successful at it already for decades.
Oh, absolutely.
So he might be in his 90s now, or however old he is.
I think he's like 94, 95, somewhere crazy now.
Yeah, but
still working, still active, still sharp.
Yeah, absolutely. So, yep. That's all we got for you today on The Exit. Hey, if you have not checked us out on YouTube yet, then what are you doing with your life? That's what I would say. And so anyway, check us out on The Exit on YouTube. We're continuing to ramp up the content we share on YouTube as well to add value to you, our listeners, and valuable members of the Own the Exit community. So we're grateful for you. That's all we got for you today. Go out there, crush it at business.
Grab that bull by the horns.
Grab the bull by the horns.
But be smart too. So also be diversifying.
Yeah, and
also
think like an
putting
investor.
some money aside. Be an
Think like an
investor.
investor. That's our takeaway. Be a business owner who also thinks like an investor. All right. We'll talk soon. Yeah.
Thanks, everyone.